Right. So before we kick off, the purpose of this talk is to give geoscientists like ourselves a strategic or big picture understanding of how their technical work fits into investment and value creation in mining. By the end of the talk, I hope to help connect the dots between geology fundamentals, exploration workflows, resource reserve modeling, ESG and regulatory issues, and wrap it up with project financing and the intricacies of deal making. Okay. Yeah, you've heard a bit about myself. So long story short, I'm a geologist with about 17 years of experience, but then I moved over to the dark side of finance back in 2018, where, as Buffalo has explained, I joined a variety of companies, lending my technical expertise in order to help close deals in the mineral space in Africa, the Middle East, and around the world, basically. I'm a proud ex-Vitsi. My alma mater is UNAM, and I studied at the University, the Imperial College of London here. Okay, right. So this is a table of contents. We'll delve into the geology, the basics. Um, we'll speak about exploration, a bit about resources and reserves, ESG, and finally tie up with financing. So geology, the basics. So geology, in order to understand mining and exploration, the fundamental principles of geology must be known. And geology is often looked at as being a black box with a lot of jargon, and people really don't understand the intricacies before speaking about this topic that we are all pretty clear about. So, rocks, minerals, and elements obviously form the basis of everything in the industry. They help geologists identify where different minerals are. They help us geologists also understand where certain deposits may be based on the characteristics that we may find in the rocks, minerals, and elements. So basically, having a good understanding of these fundamental building blocks will help geologists fundamentally identify where ore deposits are. Okay. So plate tectonics, in addition to this topic that I've spoken about, helps us understand where mines are found in the world. The map on the left shows where mineral deposits are found in the world, and you can clearly see that there is a clear distinction between tectonic plates and where mines are found globally. So mines are associated with specific tectonic settings, basically. So mines and minerals are basically found everywhere in life. I mean, everything that we touch and use is either grown or mined. Therefore, it's really important for us to to develop a clear understanding and appreciation of metals, mining, and how we find these items that we take for granted in daily life. This image is just a depiction of what I've mentioned earlier on, and it shows a smartphone. So basically, a smartphone contains about 60 plus minerals, including gold in circuits, lithium in batteries, rare earth elements in screens. And the reason why is important is because it demonstrates how important mining is in regards to its relevance to technology. So without mining, there would be no technology, there would be no innovation, and therefore it's incredibly important for us to have an appreciation of this um, field of study and how it feeds into daily life. So this slide basically it depicts how the future demand will develop for minerals. So over the next 30 years, according to EY, the industry will need to mine more ore than has been mined over the last 70,000 years to meet the exponential demand for minerals in the energy transition. So as we know, everything is transitioning from being, the economies are transitioning from becoming dependent on fossil fuels and coal into becoming more greener. And in order for us to get the green elements, the coppers, the niobiums, and the rare earth elements, we need to mine. How do we mine? We need to explore. And this is how we get minerals out of the ground. And that will be the precursor for the next section, mineral exploration. So I chose this image because mineral exploration is pretty much like treasure hunting. A geoscientist fundamentally looks for certain clues in order to solve a case and test out a bunch of hypotheses. The process of exploration can easily be summed up into these 5 steps. So exploration basically is a set of processes that's conducted of a very large area where we narrow down certain anomalies in order to generate targets, and we apply a series of decision gates to understand whether to move ahead or not. Exploration is not a race, it's a marathon, and therefore this process takes several years to complete. You often find that people in the industry speak loosely about the term of exploration without having a fundamental understanding of how intricate and how much it entails in terms of the processes that are involved and the time. Okay. The exploration process can be summed up into these four key steps. I always use this as a benchmark, and it helps you understand where you are in the cycle. First of all is project generation. After project generation, you delineate your targets, then drill testing, followed up by resources and reserve generation. Now, this little video over here, which I'll play for you, will help explain the difference between two very important types of exploration, greenfields and brownfields. So let me play it for you. Exploration is to find new deposits that can become a body. There are two major types of exploration, greenfield and brownfield. In brownfield, the goal is to secure deposits close to an existing mine. This can be done either from the surface or from inside the mine, which can be more efficient compared to surface. The benefits with brownfield are that you can use the existing infrastructure of the mine and that the geological conditions are normally known. In greenfield, the goal is to find new deposits in an unexplored area, which is a much higher risk. Before starting with core drilling, a number of steps need to be executed. This can vary from country to country. Study all available geological maps, satellite pictures, and possible available airborne geophysical surveys. Collect samples from stones and outcroppings of rocks for local geological mapping. Make local geophysical surveys, for example, through electromagnetic surveys. Collect geochemical samples in vegetation, sediments, and in shallow boreholes. The last and most expensive phase is core drilling. There are three kinds of players in the exploration business: major mining companies, junior mining companies, and drilling contractors. Drilling contractors are normally suppliers to the major and junior mining companies. Yeah. So basically, that video sums up the key differences. As you would have heard, greenfield exploration is conducted on virgin ground. There's very limited data, and economic or its presence thereof is really not known. So it's pretty much a gamble. However, the great thing about greenfields exploration is that there's a very large resource potential, and the players have a really large degree of freedom in terms of how they want to explore. The drawback of this, however, is the success rate, which is less than 1%. So it's indeed a gamble. Brownfield exploration, on the other hand, is totally different, as you've heard. It's near or at an operating mine. There's existing infrastructure. There is a large knowledge base. The ore presence is already known and it's relatively low in cost. And the kicker here is that the exploration success rate is around 5%, which is orders of magnitude higher than brownfields. Therefore, you can understand why it's a preferred means of exploration. The image on the far left shows a mine owned by Capstone Mining in South America, where the green shows the ore body and you have the purple and blue lines which represent development. And the purple lines here show drilling that is basically planned over and beyond or beyond the existing ore body. Therefore, it qualifies as brownfields because it's around a known deposit. Okay. So project generation is based, as I've mentioned, is the first stage of exploration. You create a pipeline of new projects, you're reviewing geology from historical and mining data, and you conduct desktop studies using satellite imagery and databases. The Ministry of Mines and Energy in Namibia has got a wonderful database and a great knowledge base in terms of maps and historic reports and the like. So your local geological survey is the first stop of exploration. It basically helps you identify new mining opportunities. As I mentioned, target delineation helps you answer the question from maybe there's something here to let's test this specific spot. Um, in this process, we engage in detailed sampling and geophysical surveys. We develop anomaly maps therefore we also rank these anomalies and targets and in terms of their prospectivity and then decide where to go from there. So we basically narrow down the hunt for what we want to look for. Drill testing is one of the final phases of exploration. It's actually the most expensive part. You basically drill holes into the ground to confirm economic mineralization, map the subsurface, and you have a variety of drilling methods, diamond drilling, RC, auger, and the like, in order for you to understand what's happening at the ground, under the ground. So I'm very conscious that I could be preaching to the choir here, but these are all aspects that would tie up to the end, and you'll see very soon. So resource or reserve generation is when we quantify or answer the question of how much there is in the ground and whether it's worth mining. We engage in 3D modeling and we apply a whole bunch of modifying factors, cutoff grades, prices, and recovery rates, and therefore further break down our resource into an inferred, indicated, or measured category. And if it's a reserve, a probable or proven reserve, which basically tells us what level of confidence we have in the geological data. I like this image, firstly because of the very handsome geologist on the right, and on the left-hand side, which shows us how we move from having hundreds of prospects to few prospects with an idea of how much is spent. So basically, you start off with hundreds of prospects over a very large area. From there, you narrow it down into, like, for example, 120 prospects. Your cost at that point is about $1 million or less. Therefore, when you drill test, you reduce your prospects from 120 to 24. Your drill testing will be more expensive. As you can see, the budget is between 1 and 10 million. As you move to resource generation, you move from 24 prospects to 5 targets, and you have to spend even more money, between 5 and 100 million. And when you actually find a mine and you have delineated a reserve, you would have to spend between 20 and 200 million. So what it's telling us is we start off with many prospects, we narrow them down, but as we narrow them down, the studies become more advanced and more expensive in order for us to narrow in to the target of gleaning a reserve. Okay, it's a very systematic process and expensive. So mineral exploration techniques, there's several ways in which we can engage in mineral exploration. Remote sensing, where we use satellite imagery and spectral imaging to locate minerals. Geophysics, as we all know here, which helps us use physical properties of rocks to determine what structures lie beneath the ground. Geochem, where we use analyses of rocks and water samples to identify elemental anomalies before drilling. Good old geological mapping, where we have boots on the ground and we identify rock types, faults, and alterations to provide a fundamental understanding of an area's mineral potential. We have drilling, as I've mentioned, and all of these processes combined are the techniques that we employ in exploration. As you can glean from what I mentioned before, exploration is a data-driven process. It involves building a bigger picture from a whole bunch of little clues. We layer the data one on top of one on top of the other, and we move from a regional to a more focused sort of targeting. However, let's be real, only one out of 1,000 technical anomalies turns into a mine. However, it's really important to have good generative work to supply targets. The image on the far right, as you can see, is from Barrick, and they have this really cool triangle which shows the number of prospects that they have in greenfields and how they progress into actual mines. If you look at North America, for example, in this particular year, they had 10 exploration targets in greenfields and 35 in brownfields. As I mentioned earlier on, brownfields targets appear more sexy on the basis that you have a higher chance of finding something as opposed to greenfields targets. But as we move further up the triangle, you can see that the number of inferred resource conversions, projects that have moved to feasibility, becomes less and less until you have, for example, only two projects at the top that have reached the construction and development phase. So very useful to know. So Exploration, as we have learned, is expensive and it takes time. According to the USGS, over 70% of exploration projects never advance to mining because early stage exploration and targeting is super critical, and the industry has been taught or must learn to fail fast and leave certain projects. So 70% of projects never become mines. In 2024, according to the Financial Times, about 12.5 billion US dollars was spent globally on exploration, and it takes on average about 7 to 10 years to move from exploration to an actual mine. So after looking at these very bleak statistics, you may wonder, why do people even engage in exploration? Why is it deemed as something interesting for investors when they could, for example, just open up a McDonald's? Okay, and here I'll explain why. A $1 million drilling program can help find a deposit worth $1 billion. And there's absolutely no way in finance that you can get this degree of optionality. Yes, it's true that most programs fail. However, when you succeed, you really hit it big. In finance, we refer to exploration as having a call option on a deposit, where basically you have all the upside, and all you only lose what you've invested in. So your upside is unlimited, but what you only lose what you invest in. So it's seen as a gamble, but a very educated one because we're applying scientific principles in order to narrow down targets. Okay, resources and reserves. So let's say we have found a target. How do we quantify it? How do we report it? What's a resource and what's a reserve? This section helps to clarify what a resource and a reserve is in terms of how they're classified, with a focus on understanding what grade is, tonnage, and reporting standards like JORC and NI 43-101, which help us to get an understanding on project feasibility. This is fundamental when dealing with finance. All right, as I said, these are the terms that we'll be talking about: what's grade, tonnage, a resource, a reserve, and recovery. So grade is king, okay? It's basically the concentration of valuable minerals or metals within an ore deposit, and it's expressed as a percentage for some metals or grams per ton for other metals. And it basically it gives us an idea of the economic viability of a deposit. So the higher the grade, obviously, the more resistant the project will be during low commodity or price cycles. So from an investment point of view, higher grade projects are always favored. Okay. Tonnage, I always like to say if grade is king, then tonnage is queen. Um, Tonnage officially actually just means the total weight of ore in a deposit. It's typically measured in metric tons and represents the quantity of material available for potential extraction. Tons are queen because they help us to determine not only the scale, but the longevity and the strategic importance of a project. So having a really successful mining project means having a balance, if you will, between grade and tonnage. Okay. High grade, high tonnage is always the best. Okay. Recovery, on the other hand, I would like to say is extremely important because there are three things we should look at when dealing with recovery: maximizing it, extracting it, and turning it into profits. Recovery is basically the percentage of valuable minerals that can be successfully extracted during ore processing. Higher recovery rates basically mean that more of the metal is obtained from the same amount of mined rock. So fundamentally, you want to have a higher recovery in your grade, in your ore type, than a lower one. The image at the bottom shows a couple of ore micrographs or photographs of, um, of gold. On the far left, at number one, is free milling gold with an 80+% recovery. The image at number two here shows coarse-grained uh, mineralogy, and the recovery here is a bit lower. I think it's around like 40%. As you can see, the gold particles are really locked in the lattices of the gangue minerals, and this will require a great deal of grinding and cyanide leaching with flotation. And as you move to the far right here at number four, that's the refractory ore. Now, refractory ore is a lot harder to get out of the rock and requires, for example, pre-oxidation, cyanide leaching, and flotation, which requires a lot of money. So if you are an investor and you are Assessing projects, it's always better to go for projects which have a higher recovery and a metallurgy that's well understood with few deleterious elements. A resource, on the other hand, is the concentration or occurrence of solid material in the earth. The official definition tells us that the form is known, its grade, its quality, and quantity are known, and there are reasonable prospects for eventual economic extraction. So mineral resources are known. They're estimated from interpreted geological evidence and sampling. And what is important to note here is a resource is never stagnant. A reserve, on the other hand, is that part of the resource that can be economically extracted. Um, so think of it like let me think. Think of it like like spotting fruit on a tree. You know that there's something valuable, but you're not sure yet if it's worth picking or not, or if because it's out of reach. So a reserve, in layman's terms, is basically that. It's that portion of the ore body that is economic, that you can actually exploit at that given time. The reason why this is important is because within finance, you may find some punters don't know the difference between a resource and a reserve, or they use the terms interchangeably, and that can often lead to problems. So I came up with a useful analogy. Um, when you're thinking about a resource, think about a pie. Uh, the entire pie is the resource. However, the reserve is that portion of the pie that you can eat today or that you're allowed to eat. The image on the left is a bunch of tea. Well, it depicts a tea with sugar cubes jumping into that. So the sugar cubes depict your grade. So the sweeter the tea, the higher the grade, and that's what you're looking for, right? In order to determine what a reserve or a resource is, there are certain tests or studies that need to be conducted. Um, for in the preliminary phases, you have a preliminary economic evaluation or a PEA, and that basically tells us what it could be. A PFS tells us what it should be, and a feasibility study tells us what it will be. But as we move from a PEA to a feasibility study, the cost accuracy becomes a lot smaller, which means the margin of error becomes less, and the engineering input becomes more and more. Okay, so as you move from a PEA to a PFS when determining what a resource or reserve is, you have more technical input, more engineering insight, and a higher degree of confidence at the end of the day in terms of whether this reserve can be economically extracted. Okay. There are certain reporting codes and standards that we use when speaking about resources and reserves. The reason why this is important is because it helps in the investment sector understand or have a standardized or verified manner in which certain terms are spoken about when trying to raise money on the stock exchange. They also help us assess whether projects are economically and technically feasible before committing capital. In addition to that, they are also required by regulation in terms of regulation and compliance in order for a company to be publicly listed to declare that they have a resource or reserve. And so we have, for example, JORC, SAMREC in South Africa, NI 43-101, and the like. It helps us, as I said, build a degree of transparency and reliability. It helps us as geoscientists communicate our technical and economic feasibility of projects. And it also highlights the importance of the QP or qualified person as a gatekeeper of this information. All right. So the case study or the main reason why this came to pass is because of BRIEX. Some of you may have known what BRIEX was about, but some of you may have not, and I'll just glean over the topic to give you an understanding of why this case study is really important. So BRIEX, taking you back to the 90s, BRIEX was a Canadian company, and they had a deposit called Busang in Busang, Indonesia. So the deposit was a low sulfidization epithermal gold deposit, and it was out hosted in altered volcanic and intrusive rocks. The target that they claimed to have found of that deposit was 70 million ounces, which was huge at the time. At its peak, Bre-X's market cap exceeded 6 billion Canadian dollars because of this information. This is a timeline of how this disaster unfurled. So in 93, Bre-X claimed that they found this huge deposit of over 70 million tons. In 96, the stock price surged to, as I said, increased the market cap of the company to over 6 billion Canadian. It was then discovered that their chief geologist, Michael de Guzman, had salted samples by adding gold dust to them and deceiving or assay results and making them out to be higher than what they were. So independent tests by companies like Freeport-McMoRan revealed that there wasn't any gold, and this basically caused Rex's stock to plummet, and the company lost a great deal of investor equity. So the aftermath of this were a slew of lawsuits, and it led to the formation of the NI 43-101 technical report or technical standard. In terms of facts and figures, Bre-X's stock surged from 30 cents to $286 overnight, and the loss incurred was 95,233%, which is the biggest loss that has been incurred on the Canadian Stock Exchange. The amount of gold that was actually found after due diligence was zero. The investor value lost was 3 to 6 billion, and 99% of the market cap of this company was lost. The reason why this story is extremely important is because at that time there were no checks and balances in place in order for the stock market to verify or validate the claims of the company. And so basically, after Bre-X, NI 43-101 was adopted, and in order for one to list on the Canadian stock exchanges, there is a standardized reporting procedure and an emphasis on the qualified person in order to verify the claims that are presented therein. So it's a sort of safety net. Now, the next topic that I'll talk about is ESG. The reason why it's important and how it factors into mining projects and finance is because um, sustainability and community impact and governance and managing these risks are incredibly important nowadays in order to attract investors. I have been on boards where certain investments haven't gone through because ESG criteria haven't been met. So the next section will glean over what ESG is all about, its importance, and give you a few case studies. So ESG stands for the environmental, social, and governance aspects of mining, of anything. It helps us manage risk, improve, guard our reputation, attract investment, and also contribute to long-term sustainability. This image on the right here was developed by, I think it was by EY as well, and it shows their top 10 risks in the mining industry. And environmental stewardship is at number 2. So it goes to show how important this aspect is. Okay. So a case study that I would like to speak about that I always draw on when trying to explain the importance of ESG and investment is the Salares Norte mine owned by Gold Fields. A bit of background. The Salares Norte mine is in North Chile. It's a high sulfidation epithermal deposit, and its size is around 25.5 million tons and 4.76 grams per ton gold. So it's a very high grade gold deposit. In comparison to a Namibian equivalent like Navaja, its resource size is slightly the same, roughly the same as Navaja's, but Navaja has slightly more pure gold than this project. Now, the reason why this project is important is because the development of the project was halted because of the presence of a couple of chinchillas, 25 to be exact. Chinchillas are, chinchillas, for your information, are very small rodents that are endangered in some part of the world, but they are prized for their fur. And as you can see on the far right is some of you guys' favorite rapper. I will not talk about his personal life, but he's sporting a very expensive chinchilla coat. There was a great degree of regulatory standoff. There were failed relocation attempts and production delays. So basically, capital of 1 billion US dollars targeting 580,000 ounces of gold was delayed because of the presence of um, these uh, uh, these little endangered animals. Okay, so the considerations or the takeaways from this in terms of ESG is if investors ignore ESG, it can derail investment. It's very important to have early community engagement, early environmental studies in order for you to glean, or in order for a company to obtain a social license to operate. Reputational damage, if you don't take care of ESG issues, has absolutely no value. It can be immeasurable. And therefore, it's very important to ensure that there are very strong governance and transparency principles in place. Okay. So, um, you'll be glad to know that the Solaris Norte project is now going on. It's on stream. And yeah, I think that the chinchillas are happy now after the company demonstrated that they were able to take care of them and relocate them to a safer space. So financing. Yeah. This is a very famous quote from Mark Twain. And he said, "A mine is a hole in the ground with a liar on top." And this quote came out of the fact that earlier on in the 1800s, there was a lot of mining and exploration, owning of these assets was seen as a black box and a sort of like money maker with where people really didn't understand or couldn't see what was happening in terms of, the valuation of projects. And it was basically seen as a very opaque and weird business where people where that attracted many charlatans. Okay. Now, the financing phase is the process of unlocking capital, and three important things happen here. First of all, the project is validated. It's reviewed, the feasibility studies, the technical viability is looked at, the economic viability is looked at, a great degree of due diligence on geology and engineering and tax and the like happens, and risks are identified, as well as opportunities in the plan. During the financing phase, finance is also structured, which means that the an appropriate mix of funding, whether it be debt, equity, or streaming, is put together, and it's all put under a structure where short and long-term capital needs of the project can be taken care of. A very important part of this phase as well is engaging with stakeholders, where the company or the geoscientist would coordinate with strategic partners, off-takers, and engage streaming, royalty, and debt providers in order to get funding that the project will need. A corporate geologist would ideally be involved in all three phases. However, a more technically apt geologist would be their services would be really used in the initial phase of this process. This curve here is referred to as the Lassonde curve. It basically shows us how the value of a mining project evolves from exploration all the way through closure. In the exploration phase, the value of a project rises really sharply as exciting geological discoveries are announced. The information is driven, I mean, the rise in value of a project is driven basically by the geology and enthusiasm. However, the project will enter what is known as an orphan period when there are technical challenges, there are permitting issues, and there's a slow process in terms of gleaning finance. Investors often lose patience during this phase, even though there's a great degree of critical de-risking work that's been done. And as the project moves from the feasibility phase all the way through to construction and production, the value climbs again, and it often exceeds, as you can see, the value at exploration phase. So the reason why this is important is because the moment you understand where a project sits on this curve, it helps you assess the risk of the project. And investors often call on this curve to understand how risky the investment is for them and where it is they would like to be on the curve. So it reminds us that geology is the starting point, right? It's just a starting point, but engineering and financing and execution create long-term value. So geology and that input feeds fundamentally into financing. Okay. The types of project finance, as you've heard me mentioning earlier on, I've mentioned debt and equity and royalties. But what are these things? So equity basically are funds that are raised through public issues and shares and the like. And it's often a form of investment that's used in early stages of exploration. You find venture capital funds and juniors putting their money into this because it's an extremely speculative part of the phase. Um, the reason why equity is preferred is because it's, these people who have money usually um, don't want to have rigid repayments and want to have freedom in terms of how they would like to play with their finances. So they don't want to approach banks and therefore don't engage in debt. They rather stick to equity. Okay. Debt, on the other hand, as everybody will know, is linked to banks. So basically, you take out a loan and you pay back the loan in this instance from future cash flows. So obviously, if a person has a deposit and they say, well, I would like to get debt to finance it, they don't have money on hand, but the future cash flows of that project would then be used to pay back the loan that was given by the bank and the interest thereof. The reason why debt is used further on is because there is a great degree of due diligence that debt providers demand. So debt providers are never going to finance early stage projects. They'll usually focus on projects that already have a feasibility study that they can query and stress test. Okay. So debt is used for later stage development and construction projects. Royalties, on the other hand, is upfront cash that's paid for in exchange or a percentage of future revenue. And the the royalty sort of model is used for late stage exploration and production assets. Streaming, on the other hand, is when a company is paid um, upfront cash in exchange for the right to buy future production at a discount. So, for example, if I have a gold mine and I'm looking for cash because I would like to improve my plant. If I speak to a streaming company, they may give me a certain amount of money in order for me to take care of my current situation. However, the exchange is that they have the right to purchase the gold that I produce at a discount or at a lower price than it would be in the future. So we agree on a price, we hedge a price today for future production. And obviously, this sort of finance type is used for more advanced projects. This image here is extremely useful. It helps you understand, as I mentioned, what types of investors invest when. Risk-loving investors invest at an early stage. That's at the concept phase, when there's drill testing, and they often invest using equity. However, as you move into late stage development, you have more risk-averse investors like your banks and you know, your financial institutions and majors that would like to see feasibility study and more advanced work that has been conducted, in terms of your technical studies and the like. Um, the mine stage and the operational stage isn't really a place where uh, a lot of investment occurs. However, you do find some banks, some strategic partners, some some institutions, um, you know, like to look at mines that are in the operational phase. However, from a risk return point of view, most investors would like to get in early because your value diminishes at this point in terms of your return on investment. So we've spoken about financial terms, we've spoken about resources and reserves and the like, but the question is, okay, this portion of financing is usually filled with bankers and finance people. What's the role of the geoscientist? So, as I've mentioned, there are different types of finance: debt, equity, royalties, and streaming. Now, in terms of debt, the role of the geoscientist at this point is to prepare and
My dear
review.
bandits, I'm coming cold here now. Yeah.
Um, Sorry, I think
Oratile,
someone's
oratile,
talking.
Sorry, can somebody mute it, please mute? I will try to do it from my side.
Oratile, where are you from?
Okay, I can do it. Sorry about that. Carry on, please. No?
How are you feeling about the results?
Oh,
Let's have results.
I think I muted the wrong person. There we are. Solomon, sorry, can you unmute yourself? I think I muted you. Hmm, maybe
Yeah,
not
okay,
because
cool.
okay, there
All
we
right.
are. Perfect. Sorry about that.
Okay, all right. I think where was I? I was back here. Okay, so what's the role of the geoscientist at this point? So when raising debt financing, usually you have investment banks that put together debt and some private equity funds. Um, they would prepare a geologist a geoscientist at this point would prepare or review feasibility studies, validate reserves, and conduct sensitivity analysis and uh, and provide input into financial models. So, for example, if a financial model is being built, a geologist may say, well, hey, as a risk, be careful because this project is structurally complex, or the the recovery of this project is dodgy because there are deleterious elements, those sorts of technical inputs, which financial people would then be able to flex in financial models in order for you to have a good idea of the intrinsic value of a project. In equity, geoscientists will help define targets, interpret drill results, prepare reports, and also get a degree of an understanding of exploration upside and upside in terms of the resources when putting together equity. In terms of royalties, as I said, which and streaming, which both happen at the end of the curve, geologists are geologists and geoscientists in general are incredibly important because they help confirm forecasts, evaluate mine plans, and communicate technical risks to the partners who are putting together this sorts of financing. So when I say geologists, I mean geoscientists. Mining engineers, geologists, metallurgists, and the like all work together. So technical support with an economic focus is what a geoscientist's role is in terms of putting together this sort of finance. So you often heard about M&A. M&A basically means mergers and acquisitions, or the steps that are taken in order to buy a mine or an exploration property. And this slide basically shows how a deal is done. So initially, you identify an opportunity, you approach a target, you have a bid, there's a degree of due diligence, there's some haggling and a final bid, and then a final execution of the agreement before there's closure of the deal. The items highlighted in green are the basically depict the role of the geoscientist throughout this process. The entire process can take 6 to 8 months, typically, but there is a great degree of collaboration amongst technical, legal, and financial teams. So closing a deal isn't a one-man job. Geoscientists are required, legal personnel are required, and tax personnel, tax experts are required. So due diligence, I've mentioned it several times. What is evaluated before an investment? I've mentioned the 8 key things that are really important to look at before a deal is closed in no particular order. They are the geology, looking at your grade, your tonnage, exploration potential, as I mentioned earlier. The resource or the reserve, as I discussed earlier, what is the upside here? Exploration upside, as I've mentioned. Metallurgy and processing. Recovery, as the term that I discussed earlier on. The processing method. ESG risk, whether you have a social license to operate, environmental liabilities, you have to take a look at valuation. In terms of valuation, what type of number are you putting on the value of the asset? There are various means that you can do this, whether it be by a discounted cash flow, finding out what your NPV is, composites analysis, finding out what your internal rate of return is, and the like. The tax and legal as well, extremely important. This has to be diligenced in terms of understanding who the rights of the property belongs to. Are there any stability agreements? Are there legacy issues? The jurisdiction as well, and the capital and operating costs are all bundled into some of the aspects that we look at very critically when doing due diligence. So as I mentioned with this really nice meme, blind investment in early stage projects is not nice. It's not really great. However, when you have staged financing after due diligence, it's a better scenario to be looking at. So at the end of the day, as an investor, what do you look at? You know, there's a bit of a cheat sheet here. So investors basically will look at will basically target high grade, long life assets in stable jurisdictions. They would not fall in love. They would basically drill a project or kill it very quickly. There would be a focus on exploration upside and district potential, and looking at the management team as well, because often when M&A is conducted, you will take the company and the management team, and you should have a degree of faith in the management team before signing the dotted line. So what's the takeaway message? Okay. Geology underlies everything. Okay. It's really important, as I mentioned, to understand the rocks, the structures, the mineral systems. Exploration is systematic, it's very expensive, it's lengthy, it's data-driven, and has a high success or risk/success metric that you should measure and see whether you have the goal to see it through. Greenfield and brownfield exploration differ immensely. However, there are different investment risks and reward profiles for each. Resources and reserves are technical terms and economic classifications that shouldn't be used interchangeably. ESG matters. From the example I showed you of Salares Norte, it can just take a few fuzzy animals to stop a project moving forward. So it's extremely important to have a social license to operate before you put any money into a project. Transparent reporting is extremely important. Having an NI 43-101 certified or a JORC certified project helps. It helps help investors build a degree of trust. However, you know, this is not bulletproof, but that's another argument altogether. Financing differs according to the project stage. So you have equity, debt, and royalties or streaming, but it depends on what stage of the cycle you are in. And geoscientists bridge technical and financial teams, especially in the DD or due diligence process. So investor success at the end of the day depends strongly, and I would like to emphasize that strongly, on understanding geology, managing the risk, and being able to ask the right questions so you know that you're not being hoodwinked. So to invest wisely in mining, understand the rocks, the finance is the easy part, and geoscientists form an integral part of the process. Thank you for your attention today, and I would like to open up the floor for any questions or comments.
Thank you so much,
Thank you.
Solomon. There, Professor, are you happy to manage the questions?
You can go ahead. Thank you.
Well, maybe I can take over then and just say that was an extremely useful presentation. I'm extremely sorry that I didn't make the third year geology students listen to it as a compulsory talk. They actually, I think, had to listen to the honors students this afternoon because I think in academia, we are so focused on the interesting story behind the deposits that we don't always know the intricate details of what goes behind the actual mining side of it. So I think that often the students don't hear about that, although we're trying to do more and more, especially in the honors year. And so I teach a course at the end of the third year, and they've just done ore deposits with one of the other lecturers. So I will definitely make this a compulsory assignment for them to watch, if you're okay about us loading it on YouTube, so that they can learn all the different terminology. So thank you for doing such an applicable talk. So it wasn't really a question, it was more a statement. And I enjoyed your analogy about the tea and pie. It will help me remember and explain it better.
I like food, so that's the reason why.
It's the best way to do it. Shane, does anybody else have questions? You're welcome to unmute yourself or write the question in the chat bar. I'm just going over. I don't think there's any questions loaded. So any questions that anyone has, or comments or statements. Also, everyone's homework after this talk is to go and watch the movie. I think it's called Gold.
Yeah.
Yes.
Michael McConaughey.
Matthew McConaughey, yes, based on your story it was Indonesia. So that's everybody's homework after this talk. So any questions? This is always the difficulty with online talks, is that it gets so quiet afterwards because nobody wants to interact. But if nobody has any questions, we can end it there, although it's always nice. Oh wait, I think I saw a hand. I'm on my phone. So it was a clap.
There's-
Yeah. Ray Durham says on the chat, outstanding presentation. My question actually was
Thank you.
for you and Bufelo of, did you guys study together? Is that how you know each other?
Yes, we did. Fellow and I met in 2009 when I did my honors at Wits. He was doing geophysics and I was doing geology.
Oh, okay, wonderful.
Yeah, so he and I have been
Mary
friends
also,
ever since.
oh, nice. Mary also says on the thing, great talk. You guys all have to unmute yourself and talk. There's a question on the group. What advice do you have for students who would like to pursue such an unconventional career? Although that said, I think quite a few geoscientists do go into finance. But yeah, that's a great question. So what advice would you give to students who want to follow such a similar unconventional career?
Okay, unconventional. That's a very good choice of words. So as I mentioned, understand your geology, get out into the field, have a good solid base in terms of understanding the fundamentals of exploration and mining. So work at a mine, work at it, I lived in a tent for about 4 years, so I understand exploration. I don't think anybody knows it better than me if I sit in a boardroom. So the great thing is have a solid technical background, solid technical career, and then from there, don't be afraid to venture outwards. So the reason why I made that transition is because at some point I was sitting in a management meeting and I thought that the engineers seemed to know what was going on because they were throwing around several finance terms and speaking about budgets, and I never really knew. So because I'm inquisitive and I always ask questions, I said to myself, you know what, let me upskill. So my advice to you is don't stop asking questions. If there's something you don't understand, don't be afraid to put yourself back into a classroom and then learn from the best. So what I did is that I basically combined my technical skills with a smidge of finance after going to Imperial and doing this master's in metal and energy finance. Thereafter, I worked in private equity, and I felt for the longest time that, I was able to lend my technical skills into a financial sort of setting, and they were really, really, and it was really welcomed. I didn't realize that, but the fact of the matter was I was often the guy with more technical experience, and I was able to help. So two things. Number one, don't stop questioning. Number two, um, uh, even if it means reskilling, do it. And number three, keep on putting yourselves in rooms where you are challenged and play to your strengths by lending your technical expertise into other fields.
Thank you. That's a great answer. I think, again, if you're okay about us putting it on YouTube, I'll make sure I keep that question at the end.
Yeah, that's cool.
It's very interesting. I think in academia, a lot of us supervisors hate finance because all of our strong master students go into finance instead of staying in geosciences. And actually, yeah, there is such a need to bridge that divide and not say it's an either or, but actually there's just so much benefit in doing both of them.
Yeah. No, absolutely. That's true.
Yeah. There was
Um,
another question. Oh, yeah.
Yes, there are two hands.
Oh, okay. Wonderful. I didn't see that.
I'm going to jump in there. Thank you, Solomon. Reese van Buren speaking. You presented quite a bit on the different activity stages in exploration to mining, upstream and downstream. And as I'm sure some of the audience is geophysical in nature today, what I find is that geophysical activities and the inputs and value derivation from geophysical data is quite well valued at the early stages upstream and seems to be used to attract significant amounts of investment at early stages.
Yep, absolutely.
In your opinion, how would we improve the uptake of geophysical methods further downstream? So generally what happens is, that truth machine, the drill rig, gets involved, And that's where the utilization of most of the geophysical data ends. So from your perspective, from a finance side, looking at it from the other side of the boardroom table, what do you think is required from our industry and from our experts in order to package the value proposition of geophysical methods better to be used to attract investment further downstream?
Okay, thanks, Reese. It's an amazing question. People often joke that geophysical information is great because it gives you pretty red circles that you can send drill rigs into, and it makes certain investor presentations look glossy. And that is where, and I think that in itself is a bit wrong. Yes, geophysical data is extremely important. It's